This stuff is pretty complex enough as it is. So what you want to go to, and you all should be doing this. We're going to go to, here's the introduction, blah, blah, blah. We're trying to do the optimizations to be able to trace out the efficient frontier, the capital allocation line, and find the mean variant portfolio. Okay, and then these are my companies. Here are the solver instructions. You probably want to become intimate with these instructions because it's very repetitive, and if you don't do it in the right order, it's not going to come out the way you want it to. And I'll walk you through, and I'll come around and check your stuff on Mondays. We'll be doing in-class labs where I'm going to need to come around and help you on your fundamental technical and your optimization procedures. Okay. Here is the optimization first table. Okay, everything is linked. All right, everything is linked. You're going to have to come up with the 2019 estimate. Okay, what do you think the stocks are going to do for 2019? Now it's pretty. Where are we now?
Right at the end.
Yeah, so we're already at the end of the third quarter. What you can do is just calculate the the percentage change, right, for the last since January, correct? Right, and then what you can do is you can divide it by how many months? How many are we in right now? What did we just get done with?
9.
Yeah, third quarter. So we divide by 9, and then multiply it by what? I take the 9.
Well,
Yeah.
you get a year.
I get it, and multiply by 12. I just calculated a run rate. Okay, and then I take that 1 plus whatever your run rate is, multiplied by this year's stock price to get next year's stock price. Okay, that's the easiest way to do it. The other way to do it is to do some research on the individual stocks, see what the EPS projections are, what the stock price projections are, and then just grow the stock out, one more year. You could even trend it, look at trend, you could do regression, you could do exponential smoothing, you could do all kinds of techniques to be able to come up with what you think the value of the stock's going to be next year, coupled with, what's the probability of a significant slowdown or some type of market shock due to, trade war implications and, the possibility or probability of extreme geopolitical, risk due to impeachment proceedings, something like that, which could have an effect on the markets. I don't know. We'll see. I'll leave that to you. But you're going to have to come up with the 2019 forecast. Now, we've already calculated, and I'll show you the machine behind this, but we've already calculated mean and median annualized returns using year-over-year changes on a daily basis, and I'll show you how that all works. So it was pretty straightforward for Apple. I was projecting Apple would probably do another 22% in 2018 because it's been growing so fast, and with the iPhone, they had some problems in China, but they seemed to overcome some of that with their newest phone. So again, you could just go through and be conservative. I always took down my projections if the stock price was doing really, really well in the last 5 years because it just basically went straight up. I might have halved, the growth rate, or used some kind of adjustment to be more realistic, taking into consideration all the information that I knew. Okay, or you could just do back of the envelope Gordon growth, or back of the envelope multiple approach to come up with some intrinsic values to compare against the current stock price. And again, you need to use a 2019 EPS, to be able to, multiply against the multiple, the peer or the historical multiple for the stock to get some kind of intrinsic value using the multiple approach. Gordon growth's pretty simple too, or you could go right into the fundamental securities calculator and start putting in the projections and having that actually go ahead and calculate the intrinsic value for you. And I'll show you that. So this main page here, this is your correlate covariance matrix for all 25 of the stocks. You don't have to do anything, it's already programmed for you. What we did was we took the highest here, we took the lowest, divided it, took the spread between the two, the high and the low, and divided it by 14 to get the return, right here, the returns between the high and the low. Okay? And then what we do is we basically just take, and these are all programmed right here. So what we do is we just put that one in there, run the optimization, and boom, it kicks out the weights. And then you run the second scenario, the third scenario, every time you're doing the quadratic optimization through Solver. And I'll walk you through that. You know, once you kind of get it down, it may take a couple times for you to kind of get the handle of it. But once you've gone through it a couple times, then it becomes a lot faster and you kind of get it. The biggest problem with this is you have to have a sole person. You have to have one person working in MS Office, not in Google Sheets. Because what will happen is you'll open it up and you'll save it down, and then Google Sheets will open it, and then you guys start bombarding the spreadsheet, and you blow up the macros. Okay. So what we found out of the last few semesters is you got to pick one person to basically pull it up and then save it down, and you got to keep the integrity, you know, of the worksheet, because the optimization is huge. I mean, it's calculating a factorial, you know, combinations of 25 stocks. So it takes a little while to run. It's pretty amazing. I mean, before it maybe takes like a minute now to run or less. Before it used to take, you know, 20 minutes or 2 hours or 2 days or 2 weeks to run the optimizations, depending on the degree of technological advancement, you know, of the compute, you know, that you were using at the time. But Excel can totally handle it. And I'll walk you through all of these procedures. And I also have the steps are laid out right here. Get my computer to work. Okay. So here are the steps. These are the 3 optimization procedures that you're gonna walk through. It gives you all the instructions: first step, second step, third step. First step, second step, third step. It's all basically laid out. And then ideally, as you run the optimizations and then copy and paste these cells, you want to do 81 to 107, and you copy it and you paste it, you know, unformatted as a value. Then basically you run the optimization again using the second return scenario. It's going to kick out here the portfolio standard deviation, which is what you're doing. I'm going to copy that, you know, 81 to 107. You should probably write that down and copy it. Paste it over here into scenario 2. Bam, just values. And what you're doing is you're going through the iterations. And what you're doing is you're rerunning the quadratic optimization, the portfolio standard deviation under different return scenarios. Okay? And then the one that you pick at the end of the day is one that's going to provide you with the highest Sharpe ratio, but I didn't use the Sharpe ratio. I just used I thought it was more intuitive just to use the expected return or the mean return on the portfolio divided by the standard deviation, you know, of the portfolio, so I could get my return to risk ratio. The Sharpe ratio kind of, even though it's more theoretically accurate, it's less intuitive, and the risk-free rates are constant anyway, so it's not going to have a material effect on the outcome of the portfolio. And then you pick the one that gives you the highest return to risk ratio, and these weights are the weights that you pump into your passive static portfolio that you just did. You start messing with the market caps to replicate those weights, and now you have the forward test and the back test for the active approach. Okay. And I'll walk you through these things more, but this is how the final procedure is to run the capital allocation line, which allows you to see the tangency point for that mean variant portfolio that's going to give you the highest return to risk ratio. And in that case, I forgot what iteration was, but the return to risk was 2.7 units of return per unit of risk. This is a pretty good efficient frontier. Some of them that I've seen were a little bit weirder, but this one's pretty normal. Obviously, these portfolios down here are your inferior portfolios. You can't sell those, because why would anybody buy a low return, high risk portfolio? They wouldn't. They may buy some of these out here if you market them, but what we're looking for is really that tangent point, the point where the portfolio is providing the highest given level of return for the given level of risk. That tangency is that 2.7 unit of return per unit of risk. Okay, so that's it. You don't need anything else. And then here's a picture that shows you how to solve, go through the iterations. This is what the solver looks like. I'll walk you through on how to pull it up and load it. Okay, but I would have one person do something, maybe two people, but I would have one person do the portfolio iterations, and maybe one person can load the data and check all the back end stuff so that the data is being calculated correctly. You're going to have to audit it. Then the efficient frontier optimization, and then capital allocation line. Okay. The next is, and I tried to set this up with some break pages. Here's your covariance matrix. Okay. So based on the return series that I'll show you, you'll run through the covariance matrix calculation right here. Okay. And then this feeds into the other worksheet. Okay. What you'll want to do too is, for some of you who have stocks that don't have 5 years of data, what you're going to need to do is to basically find other stocks that are highly correlated to the stock that you don't have 5 years of data with, and run the correlation matrix. And then take the return of the stock that you do have data with, multiplied by the correlation coefficient, to basically get the input to fill in the rest of the 5 years for the stock where you don't have data. Okay, it was the only way I could figure out how to actually do it the right way, unless you reverse, you reverse forecast the stock price, right, based on some long-term trend. Okay. Although I wouldn't do that, because you're going to basically, when you smooth it out, you're smoothing out the volatility. Okay, and there's a lot of information in the volatility in the prices. Yeah.
So for a standard deviation or forecasted standard deviation, that's just a historical average?
We're not forecasting the standard deviation, but the standard deviation calculation for the portfolio, standard deviation is based off the historical data.
Okay. And
we're not forecasting a standard deviation. The assumption is if the return distributions are normal and stationary, they don't really change that much. The returns may change, because you're calculating means, and I didn't do a filtering process on the return distributions. But usually the standard deviation is not as affected due to trends as the return is. The assumption is that the standard deviation is stationary, and it's the true standard deviation.
Got it. So standard deviation stays put, and then the expected return for
you forecast
is just our mean.
Yeah, you just forecast whatever it is for 2019.
Got it.
Okay.
Yeah.
Are there other schools that thought about using like historical returns for standard?
That's all we have. I could do simulations and probably run a Monte Carlo simulation using historical data and maybe tweaking it or shocking it to do maybe a recession scenario. If I really believed it, I could probably do it that way.
Would you do like a random between or something?
Yeah, I don't know. I might use certain time intervals where I'm just capturing time intervals. If you think you're going to go into a corrective phase in the business cycle in the capital markets, I would use that first 3 years of data, right after the peak, and then use that as a simulation. Use that data for simulation. But we don't have time to do all the financial engineering. I mean, the comment so far on this experiment is that most of the other schools, even at Yale and Princeton and stuff, they're doing stuff straight from the book. They're not doing any kind of application. So when you run across, through your interview process, when you show them this stuff, they're going to be asking you what grad school you went to or what school you went to. And the feedback so far has been, wow, this is really amazing you did this. And then the other feedback was, gee, we just didn't look. But you guys are actually doing stuff, okay? All right. So the next is here that's calculated is the return data. So this is basically just a data block, okay? Going back 5 years, calculating the annual change based on daily data. So it's 365 change on a daily basis. Why did I do that? I don't know. I just, my problem is that I always run into data constraints. I never have enough data, and I don't have huge, thousands or hundreds of data samples to really pull from. I probably, this is almost like a simulation. Okay, I'm taking 5 years of data, going back 365 days, for at least 4 years. So I have, over 1,000 returns that then I can create a normal distribution out of to calculate the mean return to do the forecast, and then have a robust sample to calculate the true, standard deviation. Does it work? I think it works good enough, actually. I could tweak it, but I just didn't have time to do more of the engineering. So here's the annual returns for all 25 of your stocks. Okay? And I don't know why this isn't hard-coded. I don't know why it's hard-coded. It should be linked to your page. So you may want to go back and make sure that it's linking up. This first cell links up to your stocks across the top. All right. And this is a pretty robust time series. So I got annualized daily annualized data for 107 samples, 1,007 samples. So I have 1,007 annualized returns using the daily year over year. Okay, and you need to be comfortable with that, because you're going to be doing analysis, and you're going to go, let's use quarterly. Well, quarterly is not very good because you only have 4, right? Maybe we do year over year on a monthly. Okay, now I got 12. Now let's do year over year, on a weekly, basis. Now I got 52. Now let's do it, year over year on a daily basis. Now I got 365. So I can manufacture data samples by changing the time interval. Okay? And you need to feel comfortable about that. So what's going to happen is when you pump the data to calculate these returns, you're going to see that some of your stocks are not going to have historical data going back 5 years if you're using small cap tech stocks in particular. So what you're going to do is you're going to have to find out the last cell in which there is data for all 25 of the stocks, and that will be the range in which you run the correlation matrix off of. And then you find the 2 stocks, maybe Apple. A lot of tech stocks are correlated to Apple because Apple is the market, right? So you can find those kind of beta stocks where the other smaller stocks are highly correlated, because all the tech stocks within a certain sector are going to be highly correlated to Apple or some other stock. Maybe it's Microsoft, or if you're doing software, operating systems or OS or whatever it is. And then here's the appendix. Right here, I basically tells you how to input the stock data, and I'll walk you through that today. So here's my companies again. Here are the instructions on how to basically get the data. We're going to use NASDAQ. Okay. Again, here's some more instructions. This is how it looks. Boom, 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 boom. This is just Apple as an example. So I'll walk you through this today. And then here's Apple, right here. This is Apple stock. Okay. And I'll show you where to go get this data. You go get the data. You basically go up here, right click, paste it, boom, it calculates everything. And then you got to do some auditing to make sure that all of these returns are calculated here. And I'll show you some techniques if you have missing data here, we can fix it. Okay. But this is, and right here it also shows, here's the return distributions for Apple. Okay. Does that look somewhat normal? It's a little flat, so it's pretty wide. I'm looking for a tight distribution, but it's, you know, I think it's good enough. Here's IBM, skewed distribution. I could probably go in and correct for the skewness in the distributions. Microsoft, that's pretty normal, isn't it? Oracle, CRM. So I just did a histogram of all of the returns going back using the 1007 observations. SAP. I mean, the bigger stocks that have been around the most that have been, you know, providing transparent financial disclosures in large companies, their return distributions are going to be more normal. One, because they've been around the longest, and two, they've been big for a long time. So those are going to have the more normal distributions. There's Amazon, there's Baidu. Facebook. Okay. And then what I did was I went through and I calculated these, this table here. It's basically a descriptive statistics table. This mean and median standard deviation is calculated off of this and is plugged into that first table that I showed you. Okay. And then what I did was I just ran this descriptive statistics table to compare the mean and median calculations and standard deviations from here to make sure that they were correct. So that was a validation verification procedure. So what you'll find out, what you'll learn, hopefully you learn it now, is that when you run procedures, you usually want to have some kind of validation verification check instead of always assuming that your data and your calculations are correct, because they may not, something might have happened, and it's good to be able to just double check stuff really quickly. All right, so then you have your, you do all that stuff. And then you have all of your 25 stocks. Okay. I don't even know what I have back here. This is all just garbage back there. Okay, so let's go back to Apple, all right? Because I'm sure Apple's probably in almost everybody's portfolio. So what I did was I went up onto the internet and I went to NASDAQ. Okay, I'm going to go back a few steps. So you all should be on NASDAQ. Okay, and this should be your first page right here. Tell me when you get that. Tell me when everybody's there. If you're not walking through the procedure, you're not going to remember, okay? So that's why I'm slowing it down so that you guys can see exactly what's going on. You guys all have NASDAQ up? This is actually the old NASDAQ, which is the one that I use. Sorry. So if you go to NASDAQ.com, right at the top of the page, there's going to be a banner that says, looking for additional market data, visit oldnasdaq.com, so I'll click on that. Oh, it's asking me about cookies. Okay. Now there's the old NASDAQ.com. Is everybody there? Okay. So now type in your ticker. And now it's going to go get Apple. Okay. And what you can do is you can type in all the tickers with commas, and it'll search for all of them. So you can put in all 25. And then you want to go down here and you want to go to historical quote. Okay, right there. Is everybody following along? Okay. So here's the page. And it says select the time frame. You want to click on that and you want to go to 5 years. 5 years, you should be able to scroll down. Got it. And then right at the bottom of the page, you see this Excel sheet. Click on that. What it's going to do is it's going to pull up the 5 years of pricing data. And there it is right there. Okay, come on. There it is. That's how it's going to look. And then what I do is I'm going to just grab this data, go all the way down. Okay, go down, get the time series. Right click it. Copy it. Go back to your Apple, right, Apple, boom. Click on that cell, right click it. Paste it. Boom. Change the distribution a little bit. This is the most recent data. So now you basically have you do that for all 25 years. If you have stocks that don't have 5 years of data, what you're going to have to do is run the correlation matrix. I'll show you how to do that on the data where you do have, returns for all 25 of them, and then you run the correlation matrix and find the stock that's highly correlated, to your stock that doesn't have the data. Let's say it's Apple. So then you just multiply the correlation coefficient times Apple's return, and it'll plug the return in to that stock's that's missing the data. Okay. So that's another kind of technical procedure. So once you've done all that, then you have that full data block, of returns. This one right here, the 365 annual data, this baby. Now you're ready to. Once this is all done, now you're ready to calculate the covariance matrix using the full time series, the full block. Okay, and I'll walk you through how to do this stuff. And then boom, it's going to kick out the covariance matrix. It's going to plug it into the main sheet. And then you're going to run the optimization procedures based on the expected returns that you came up with. Okay? And then it should, as you run the first optimization, which is your minimum variant portfolio, then you're going to run the 14 optimizations based on the expected return series. And then the last optimization is going to be the capital allocation one. Okay? And if it's all done correctly in the right procedures and it didn't blow up on you because you were sharing the file, again, your output looks like that. Okay. And then you do the weight, you find the portfolio with the highest return to risk ratio. What I do is I went back and reformatted all this stuff. You find that one, then you replicate these weights within your backtest model. Now you have 4 tests, back tests of the active portfolio. And then once you run through, you look at the active weights, you look at passive weights, and then you look at the technical analysis, you look at the fundamental analysis. That'll give you an idea of what stocks you want to over and underweight in the final target portfolio. And once you come up with the target weights, you're going to save that spreadsheet down again, not as passive or active, but it's going to be the target portfolio. Then you go and you start manipulating the market caps to get to the weights for your target portfolio. And then you put those weights to be able to back test, forward test, and now you have three basically performance tables. You know, you have the, I would start when the final presentation at the end, I would start with the target portfolio, and then the active, and then the passive. And those are the three products that you developed. Okay? All right. How am I doing on time?
25.
Okay. So the financial ratios, okay, there's two sets of tables. And I have never got anybody to basically work with me on this. What I wanted to do was to take these factors right here, create z-scores for each of them, weight them, come up with an overall composite index based on the financial ratios, and then resort from high to low based on financial ratios. If anybody, everybody, I usually get 2 or 3 students that say, yeah, I want to do it, and then I never hear from them. It's not really rocket science, we can pump it out pretty quickly, but to be able to create standardized measures here, and then to be able to weight the standards, which are the z-scores, to create a composite index based on, you know, unbiased financial ratio analysis, to basically create metrics, you know, that scores, indexes, whatever you want to call it, and then sort the stocks based on their underlying fundamentals, based on the financial ratios. Yes?
How do you come up with a z-score for like return on assets?
It's pretty easy. You take for each of these, let's say ROA. So I'm basically going to take the ROA for Avalon Bay, and I'm going to calculate the average return for the 25 stocks. Okay, just a straight average. Then I'm going to subtract out the ROA for Avalon Bay minus the mean, divided by the standard deviation of the ROAs over the 25 stocks. And I'm going to create a z-score for each individual financial ratio for each individual company. So it's the actual minus the average divided by the standard deviation gives you the z-score.
And the z-score is describing how it correlates.
It's basically what you're doing is you're standardizing the return distribution.
Okay.
What allows you to, what I could do is I could just do rankings,
Yeah.
where I could rank from high to low on ROA, and basically, you know, 25 is the highest and 1 is the lowest. And I could use weighted ranks as a way of standardization. I can use z-scores as a way of standardization, and I can use point score systems, where I basically assign a score between 1 and 100 for each one of these.
Because this is a fundamental weighted index.
Yeah, this one right here is just it could be called, it's an index or it's a metric. What I'm trying to get to at the end of the day is I can add up all the z-scores.
Yeah.
Here, let's say I do another page and I calculate the z-scores. I can just add up the z-scores, you know, after I control for these things, and I'll get a total of all the z-scores. And if the z-scores are correct, I want z-scores that are going to be the highest ranked to the lowest. Okay. I can also, since I calculated the z-scores, I can assign weights to these too and create a weighted average z-score, which is probably more accurate, right? Because then I can weight, you know, the ROA, the ROE, the PE, you know, more. Maybe not the dividend yield as much. Maybe the beta, you know, because obviously it's a measure of higher systematic risk, i.e. higher expected return. And then the debt to equity ratio. I probably have to come up with some range of debt to equity, right? Because if it's overweighted, it needs to be penalized. If it's underweighted, it needs to be penalized, right? Because if it's overweighted on the debt to equity, it means you've over-leveraged the firm.
So this thing is like an index that prioritizes companies that exhibit good fundamentals?
Yeah, and this is just,
Okay.
I mean, I could have used other,
And you're getting to that through the z-score normalization of each of those.
and then I do weighted z-scores. So what happens is, once I calculate, let's say, the weighted z-scores for each of the companies, then I rank them from high to low.
Okay.
And those are the ones at the top that I'm gonna probably wanna overweight in my portfolio. And the ones at the bottom, I'm probably gonna wanna underweight in the portfolio based on fundamentals. Okay. Financial ratio analysis, overall financial condition and position of the firm.
Got it, thanks.
But nobody's done this with me. Okay. But somebody's gonna have to put the data in there, and get the financial ratios. What else? There's that one. Oh, and then here, this one. This table should be actually linked, you know, to the fundamental securities table. I haven't done that yet either. Where's the fundamental securities analysts? Who's the fundamental security analyst? Okay, this is your baby. Okay. This is yours. What I found out is that people weren't spending enough time in this table. And they were like slapping data in there, and the results were all screwed up. And they were just presenting these really bad results. So I figured, why don't we start, designate your fundamental securities analyst now, so that as we work through this, I can be auditing it, your 25 stock intrinsic valuation projections. Okay. So the first here on this sheet, and you got to become intimate with this spreadsheet. Okay. These are just summary pages right here. Okay, so they're all just linked to all the other ones. This right here is just an output sheet, and then over here is the input sheet. And you're probably gonna need to update this, right? So these are gonna need to be 18, right? 19, 20, 21, 22, 23, right? And then you have up here the earnings per share. It's going to be for 2018, right? The EPS for your, and some of you might be using, you can use earnings per share for larger, stable companies. You might have to use EBITDA, right? If you're using smaller mid-cap companies, they may not even have earnings, maybe negative earnings. So you're going to have to use EBITDA per share. Okay? You might have to do the calculation by hand. Okay? Or they'll give it to you. So then you put it there, and here I just standardize the expected returns, which are the discount rates that I used. Technically, you could have put in different expected returns for different discount rates for the different stocks, right? Because obviously, WeWorks, if they were public, or Uber, or Lyft, I'm probably going to use a higher discount rate for those guys, right? Because they're so volatile, they're so new, and their business model hasn't been established or even proven yet. I mean, there still could be some hiccups. But we used 8, 9, 10, because most investors, risk-averse investors, I wanted 8, 9, or 10% rate of return under the rule of 72. I want to double my money in 7.2 years. Okay, so we just used a range. Discount rates or expected returns as the discount factors. Just again, just to be easy, because I don't want to have to use 3 different discount rates for 25 stocks. Okay, so you could start with this, and if you want to apply different discount rates to your different stocks, I'll leave that up to you, but I was just trying to, do standardization here. Okay, just make things a little bit easier. So there's your discount rates. For those of you who are in, 123 with me, this is basically programmed in Excel. I made you do this stuff by hand last semester. This time, here's the spreadsheet. Okay, and it's set up exactly the same way. So if I know what my discount rates are, and I'm going to use the 2019 earnings per share, right? I just got to divide the discount rate by the 2019 earnings per share, and that's going to give me the stock price, or the intrinsic value using perpetuity. For Gordon growth, we were assuming growth rates. These may change, right? For some of your stocks that you do in tech. This was basically large cap, right? 1, 2, 3%. Maybe Apple can do 2, 3, 4% forever. I don't know. I mean, I'm just using this, but you can play around with it if you to. See, now what you're trying to do is you as the financial analyst are starting to get into, understanding the stocks and then adjusting the discount rates and the growth rate expectations. Not only for the Gordon growth model, but also the multiples. So if you really want to do the research, I just use standard multiples of 14, 13, and 12. If you wanted, you could go look at Apple's multiples today and take an optimistic, pessimistic, and a midpoint scenario on the multiples. And just say, hey, I think, even though we're going into a recession, Apple's going to resurge because they got another, generation of iPhones and, music coming up, and I'm going to use, maybe a little faster growth rates, as opposed to just using standard growth rates or multiples. I may actually give them a little bit more multiple. It's up to you to kind of decide to keep it in a range. And then lastly, you're putting in the growth rate assumptions of the earnings per share, which is going to calculate your earnings per share during the forecast period. It actually even forecasts out one more year and applies the Gordon growth, because you already have right here, here's your terminal discount rate and your terminal growth rate, which is going to kick out the terminal value, which is going to be added to the last year's cash flow in the holding period, in which you're going to discount back to the present to get the present value under the 3 discount rate scenarios. Am I talking foreign language here? No. If you're following along, you guys are in really good shape. Okay. And then it's going to calculate the share prices for the different discount rates and put them up here. So it's all linked. And you can play around with the weights if you want to, but these were the weights that we came up with. We wanted to weight the discounted cash flow method more than the multiple, but give multiple, a fairly high weight. And then we basically crammed down the perpetuity and Gordon growth because they were very overly simplistic. And we know that multiple approach and DCF are the 2 main intrinsic valuation methodologies that everybody uses. Okay. And that's the exercise here. And then what will happen is you're going to kick out a table. There's the table in here. I think it's in the other one. Here. This is the way it's supposed to look. Basically, once you get all of your companies in, you got the ticker, you got we're going to use 19, 18, 17 earnings per share here. Your valuations for the 4 different intrinsic valuation methodologies go here. Here's your final intrinsic value. You pump in the current stock price, and it's going to calculate the premium or discount on it. Once you've done all that, then you basically highlight this. Maybe get another sheet, copy it, paste it into another worksheet with all the formatting and then the values, and then sort on premium to discount, so that now your stocks are sorted from premiums to discounts using intrinsic valuation approach, the fundamental approach. And you'll end up overweighting these at the top, right here, and you'll probably be underweighting these at the bottom. Okay. How am I doing on time?
About 10 minutes.
So then any questions on that? I'm taking you through the whole thing, and then I'm going to go back again until you guys can, get up and running. And then I'll come around again and just be working with you on a one-on basis, doing problem solving and diagnostics and stuff. Yeah.
Starting next week will be the Monday labs.
Yeah.
Okay.
Yeah, because we're going to need time. And then
Yeah.
once, one team has reached a certain level of expertise in their area, they'll be walking around helping everybody else. Yeah, because I'm not going to let everybody. You got to be working with everybody. Okay. Once you've figured it out and solved it, you move on, and start helping everybody else, so that everybody in the class is moving up at the same rate. I can't have the whole class not be at the same level. I just can't. Okay. We all have to be at the same level. And the only way you really learn this stuff is by helping everybody else out, right? Once you get it down. All right. And then the last one, and I'll go through more detail on this. And then on Friday, we'll do some more of this, bring your problems, and if you haven't done any PowerPoint presentations, we'll start doing that again, too. Okay? But on Mondays, I'll be focusing on this stuff in the teams. So this is the profit loss statement. I think I went over this already. When you go to stockcharts.com, who's the technical security analyst? Okay, this is you guys. So you're going to stockcharts.com. And you need to, you technical analysts, you need to do it exactly like this. Okay. So we'll take Apple as the first. Okay, technical security analysts. First thing you're going to need to do is go down. Oops, go down here where it says range. You're going to go 5 years. No, actually, we do 3 years. That's right. The 3 years. Then the first is the simple moving average. That's going to be 10. Second is going to be 30 days. And then the last one, you're going to add in simple moving average, and that's going to be the 50. And then you click update right there. And there's your 3-year technical chart, also with the RSI and the MACD. And the MACD and the RSI are going to give you a good indication of where the stock price momentum is going. As you can see, the RSI has been moving up, right, in a pretty strong trend. And it looks like the MACD is also in a fairly, it's above the line. So this means that Apple stock price will probably continue to go up in the near future. So these technical indicators will also help you to be able to determine what stocks you're going to slightly overweight and underweight. So there should be a technical component to it. And you can see that Apple stock has been a pretty strong upward trend, right? It's already hit its support here, right? It looks like it's hit its resistance back here. It might have actually broken out above the resistance right there. It'll be interesting to see if it gains momentum, which the RSI and the MACD says it is going to do. And it'll probably go up and then form some kind of trading range for some kind of sideways pattern. And then probably, and then we go back up again. Okay. But this is what you guys are going to need to print out, and then the technical analysts are going to have to analyze the moving average crossovers. So when the 10 crosses the 50, there's your alert. And then when the 30 crosses the 50 along with the 10, there's your buy signal. Okay. And you don't sell the stock. If the 10 crosses the 50, you need the 10 and the 30. You need a confirmation of the 30-day moving average to cross over the 50-day to get the sell confirmation. Okay. As you can see, the 10 and the 30 is well above the 50, so you're in a holding pattern. The 10 crosses the 50, then the 30 you sold. The 10 crosses the 50, there's the alert. 30 crosses, there's your buy. So basically, that's all you're doing is buying and selling this thing. Okay, just based on the rules. Okay, just based on the moving average. It's called a moving average crossover system. So the technical analyst is going to have to go through all 25 charts, or you train the next person next to you and you pump out all 25 stocks. And then somebody should check it to make sure that they were doing the moving average crossover, signals correctly. And then here's your profit loss statement. There's 2 profit loss statements here, one that actually has the data in it, and then there's another one that I added that doesn't have the data. This one supposedly is more, has more trades, because they were running out of trades to put in, so he went back and updated it. So this one supposedly is better. But what you do, you technical securities analysts, you're going to go back in time and you're going to put the trades in, what you bought it at, what you sold it at, what you bought it at, what you sold it at, what you bought it at, what you sold it at, over the 3-year time period. This is not a high frequency trading. methodology. This is more of a tortoise approach. You know, over the last 3 years on Amazon, I only had four trades, but I made money on every single trade, or I didn't lose money on every single trade. If you start changing the crossovers and start creating high frequency trading techniques, you're going to be winning, 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 losing, 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 winning, win, 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 lose, lose, win, win, lose. So hopefully you win more than you lose. But a lot of people have, you know, tried to scale these up to high frequency trading models, and it just doesn't work. This model, this methodology works really, really well. So once you do all that analysis and pump the buy and the sell signals in there, it should calculate your 3-year total profit loss. And in this case, it was about $250,000 over 3 years. So it's an average of 80,000 over 3 years, and then they did 52, 94, and 95 per year over the 3-year period. I think that's probably amount of time.
Five,
I
if you
didn't.
want it, but.
Yeah, I think I'm going to end it there.